One of my favorite rappers, Tupac, once said, "Money doesn't make the man, but damn, I'm making money." And that's kind of how I feel right now in the stock market. I'm a dividend investor. I want to share 4 stocks with you today where I am making money. This video is somewhat of a victory lap, if you will. I had this request on Twitter. I've got a lot of the subscribers here on YouTube are also following me on Twitter, and I've been just sharing news on Twitter. Some of the stocks that I own, they're just having fabulous earnings. They're having fabulous share price performance. They're experiencing massive dividend increases. I want to go through 4 of those today, and one of the followers on Twitter, one of the subscribers, the community members was like, "Hey, Ian, you got to do a video about this. You got to do a video to celebrate." And so I'm going to celebrate today, but while celebrating, what I also want to do is I want to dig into the fundamentals. I want to share some fundamentals on these 4 stocks today. I want to get into the numbers, share some more insights. And honestly, from the same album, this is All Eyes on Me, one of the most iconic rap albums of all time. Tupac also had a song called Picture Me Rollin'. And so this is kind of the video of Picture Me Rollin' as well. Just that things are going awfully well right now. And I got to stay humble. I got to stay really humble. And quite frankly, when things go too well, it's not always a good thing as a dividend investor because we like share prices going down, not up. And the share prices are going up with a lot of these stocks right now. But I'm going to cover 4 of them. I'm going to cover StarBucks. I'm going to cover AbbVie today. I'm going to cover Altria. And I'm going to cover Apple. Those 4 stocks today. And they're all in very different industries, very different companies, but they all have something in common. They are all helping dividend investors like myself win big time. So let's get started with an exciting investing video. So let's start with StarBucks. After all, that's where I was when I was responding to those tweets and I was inspired by the community to do this video. I want to start with StarBucks because their earnings were just outstanding. They had a recent earnings report. Earnings are really outstanding. And so I want to start just with some numbers on the screen. I'm going to put them on the screen right now. And Starbucks, the current price per share is $83.21. Now that is down. It is down from the 52-week high of $99.11. So it's down about 16%. And people are wondering, Ian, is it a good value here? What do you think about it? Well, let's look some more. The 2020 earnings per share, the analysts estimate, and 2020, this is their fiscal 2020, the analysts expect $3.06. And this analyst expectation, usually it is driven by company guidance. And so these companies, these large companies that I own, they will guide the analysts and they will give them a range. This is the range where I think our earnings per share will come in. That's where these analyst estimates usually come from, by the way. If I take the current share price, I divide by the analyst estimate, I get a forward PE for fiscal 2020 of 27. That answers the question right there. Is it a value? No, this is a stock that has fallen 16% from the high, and that catches people's attention. But just because a stock has fallen does not mean that it's a value. Share price going up, going down. Sometimes when it goes down a lot, it kind of gets me thinking, hey, this may be a value, but I got to look at the numbers before I can determine it. And this is just one lesson, is just because a share price goes down, it does not mean the stock is a value. And so that said, I love these guys, by the way. And so the dividend is $1.64 per share annualized. That is 41 cents a quarter. And that is the new dividend amount, by the way. These guys, Thug Life, just increased the dividend. They increased the dividend by almost 14%. They increased it from 36 cents to 41 cents per quarter. And this is why I love this company so much, as the company is growing, the revenue is growing, the earnings are growing, and they can support a growing dividend over time. Dividend growth investing at its finest. An opportunity here, not for a lot of cash flow in the short run, but long-term yield on cost. And so the payout ratio here, if I take the dividend, which is basically this $1.64 per year, and I divide that into their earnings, which are 306, the estimated earnings, I get 54%. And so it means they're paying out 54% of their earnings as dividends. And so obviously there's room there for them to increase the dividend over time, especially if they continue to increase their earnings, which I think they will. The 5-year dividend compound annual growth rate is 20%, 20.7. So the most recent increase, it was a little slower than the 5-year average, but I don't blame them. You can't keep up a 20% compound annual growth rate forever. And so coming in this time with 14%, that is reason for celebration big time. And so I bought Starbucks, by the way, last year. It's so funny. You just look a year ago at this company and there was a lot of drama and there was concern. They had 1 weak quarter and they were having some trouble with fulfilling their drink orders internationally in China. In China, they have a lot of delivery services. And my understanding is they're having trouble integrating with those technologies and fulfilling orders in a timely fashion. Stock price was down. I brought that up on the community here on my YouTube channel. I let everyone know, hey, I'm going for it here. I bought some shares at $48.14. Right now, even after it's come down a bit, it's at $83.21. Basically, I'm up 73% just since that one tranche I bought last year when it was on sale. And so the reason I'm celebrating here, quite frankly, is not necessarily because the stock price is up, because stock price up, it's exciting. It feeds the ego. It's nice. But quite frankly, I wish it would come down because then I would be able to secure better value. I like it when world-class companies, they're growing, they're doing well. Dividends are growing, but share prices are down or flat. If the share price is going up, it makes it a little more difficult as a dividend investor. But I'll just wait. I'll just wait till Starbucks has another weak quarter and I'll buy more. But for now, I'm reinvesting all of my dividends in this company that I love so much. And so I want to share on the screen also just a snapshot right now from their quarterly report. What do the headlines say at least? This isn't the full report. This is just the headlines that I'm going to share. What does it say? I want to share some stuff here. Same store sales are up 5% globally. And it looks like it was 6% US, 6% in China. And they are also saying that net store growth of 7%. Boy, they were saying something in one of the reports I was reading that they're going to open 2,000 new stores in fiscal 2020. That is just fabulous. Active rewards membership is up 15% year over year. I'm a big fan of the Starbucks rewards program. I love it. Tidbit, you'll find me working in Starbucks probably 4 or 5 days a week these days. I'm there a lot. I love this place. And most importantly, let me show, well, actually, before I get to that, going back up here, the global net store growth was 7% versus the prior year. It's led by 17% net store growth in China. It's nice to see that these stores they're adding, and again, 2,000 new stores in fiscal 2020, a lot of that focus is on China, on the international market. And so it's really nice to see that. A lot of people feel, and I'll link to a video I did on this in the description below, that an investor can't diversify internationally and then unless they buy pure play international companies. It couldn't be further from the truth. Starbucks is a United States company, but they have a good international presence and growing. And so I have international exposure just through my tried and true position in Starbucks. And so another spin on international investing that I don't think everyone looks at. I did a whole video on this. I'll link to it in the description below. So check this out. There are two types of companies. There's companies that care about their shareholders and there's companies that don't. I tend to believe that dividend companies, dividend-focused companies, really care about their shareholders. And you see this surface in quarterly reports, annual reports, in statements like this. It's not buried deep down in the fine text. It's right up at the top of the report. It says, returned $12 billion to shareholders in fiscal 2019. And they announced a quarterly dividend increase of 14% to 41 cents per share. And so they're highlighting right there, they're returning money to shareholders. And they return money to shareholders two ways. They're doing it through share repurchase and through dividends. But the fact that they're highlighting that front and center, not deep down in the subtext, but as a main bullet point in their quarterly report that they're adding value for shareholders, it means it's a shareholder-focused company. They care about me, the shareholder. They care about returning capital to me, getting me dividends, getting me share repurchases. This is the type of company that I personally love to own for the long run. So picture me rolling stock number one. This is Starbucks today. And so really excited to share the news there. But I'll tell you what I'm really excited is about the dividend increase because it gives an opportunity to achieve yield on cost. And I'll just do the calc really quick. I bought this thing last year, $48. The new dividend is $1.64 per share. And so my yield on cost for Starbucks for that tranche is a 3.4%. That's a pretty good yield on cost for Starbucks, given that a starting dividend yield right now is a 1.97%. So this is the magic of dividend and growth investing, compounding those dividend increases. I'm not even counting reinvested dividends in the simple calculation that I just did. So that's what I'm really celebrating here. What I'm not celebrating as much is the share price surging. Again, it feeds the ego. It's nice to see a bigger dollar amount for my portfolio. But at the end of the day, hey, at $83, am I buying more Starbucks? Yeah, I'm reinvesting dividends, but I'm not buying new tranches here. Not net new capital deployed, not happening for me right here. But victory lap number 1. So I want to move on now. I hold this stock really close. It's really interesting. I love this stock. I love it because there's people out there, they don't like big pharma. They don't like that, and they speak up about it. So to all you out there, in the media don't like big pharma, picture me rolling. This is what it's all about. Man, I love this company. So I'm buying this company big time over the last 6 months. I've done a number of videos on here. The thing tanked. I jumped on it. I bought in with forward PEs in the 7s and 8s. Really good values. In fact, I got a tranche on as recent as September 5th. Look, we're only in early November here. As recently as September 5th, I bought this thing at $66.98. It's already at $81.75. Picture me rolling. And so what is so interesting about AbbVie is I saw the value. I see Humira going off patent protection. They're already internationally already happened. You're seeing international sales fall. US, it's happening in the next few years. You're seeing biosimilars come to market, but you're also seeing some other good stuff. You're seeing new drugs like Skyrizi getting FDA approval. That's, by the way, why the EPS, earnings per share, for the last 12 months, it's skewed because there was a contingent consideration charge taken against GAAP EPS, which throws GAAP EPS off. It looks like the payout ratio is out of whack. It looks like the PE ratio is really high. With a company like AbbVie, you got to dig into the fine print. You got to understand, why is the earnings per share so skewed? Why is the PE so high? Why is it messed up? It's messed up because Skyrizi got approved and there was a contingent consideration charge taken on the GAAP earnings. I did a whole video on this. I'll link to it in the description below. Anyways, a lot of people get thrown off by this stock. I hold it so closely because everyone loves to hate this stock. They're buying Allergan that will purportedly close in the first quarter of 2020. Excited about that. Anyways, everyone thinks the thing is failing. I see it clear as day. It's not failing at all. It's doing quite well. And especially all of the risk is priced in at a PE of 7 or 8. So anyways, I'm going to put some numbers on the screen. So price per share right now is $81.75. Analysts expect for 2019, $8.90 in earnings. Again, largely influenced by company guidance. If I take the share price, I divide, and this is the share price after it's gone up higher than any of the tranches I bought, divide by the EPS, I'm getting a 2019 PE of 9. Still got a PE below 10. That is just fabulous. Look, I may still buy some more AbbVie here. It's higher than all the tranches I've bought. I may still buy some. Reason I may still buy some is the 2-year high, by the way, is at $123. And so we're still 34% off the 2-year high, but we're 22% up above the tranche I bought just in September. So the dividend, let's talk about the dividend. $4.72. This is at $1.18 per share per quarter. So the starting yield is 5.77%. But picture me rolling. This is what I love about AbbVie is the dividend was just increased by 10%. 10%, literally, they just announced this last week. They increased the dividend from $1.07 per share per quarter to $1.18 per share per quarter. And so why did they increase the dividend? Company is doing just fine. You'll see some more metrics in a minute. The company is doing well. They want to reward shareholders with a dividend increase. It's interesting. Why would they increase the dividend if the company was doing poorly, as a lot of people think? Hey, they're not doing poorly. Payout ratio, 53% on the new dividend. And so a lot of room, just like Starbucks, to grow this thing. Now, the difference with this versus Starbucks is you get a lot more risk with AbbVie. I'm not going to sugarcoat it. Humira coming off patent protection, a lot of debt, big merger happening, big acquisition of Allergan, a lot going on. Starbucks, look, it ain't going anywhere. Steady Eddie, consumer-focused brand. Everyone needs their coffee. Everyone loves it. It's good coffee, in my opinion at least. Free Wi-Fi. People go there, use it as their office like I often do. Hey, a lot less risk. But that's why the PE is a 27. That's why the starting yield is low. I still love it, but it's a tale of two stocks. It's a different kind of stock. My stock, it's a mixture of all different, my portfolio, it's a mixture of all different kinds of stocks. And stocks like Starbucks, stocks like AbbVie, both play a role, but they're different. AbbVie, more risk, much lower PE, much higher starting yield. It's just a different animal. And so check this out. The 5-year dividend compound annual growth rate for AbbVie is a 19.2%. Now, the most recent increase is half of that. It's at 10%. So I'm not surprised to see it slowing down. Look, they're going to have to pay off a lot of debt as it pertains to the Allergan acquisition, as it pertains to debt they already have on their books. And so I think it's prudent that they're a little more conservative with their dividend increases. But hey, 10%, boy, if you compound that over time, that is still a fabulous dividend growth rate. And so why am I excited about this? I'm excited for a few reasons. One, they announced the dividend increase, and they did it even sooner than I thought they would. Two, honestly, I'm just kind of thankful I loaded up on it when I did. I built my full position quickly, and I did it because when I see a company like this, Quality, trading at a PE of like 7 or 8, I just got to go for it. And so I built up my whole position quickly. Now, would I like to build an even bigger position? Yeah. Will I buy more here? Yeah, I'm still thankful it hasn't gone all the way back up to the 120 range. And so I'm still here in the 80s. Maybe I'll buy another small tranche. Nothing huge. But I'm mostly excited here about the dividend increase and the fact that I just moved quickly. I saw an opportunity and I moved quickly on it. And so I'm happy about that. Stock price going up. Again, it feeds the ego. It's nice. But as a dividend investor, it doesn't really get me anywhere because I buy and hold forever. I'm in this for the cash flow, not for capital appreciation. But it's sure nice. It feeds the ego. But this is a lesson to me. I've seen this more and more lately. If I see a value out there, I see an opportunity, I better jump on it. I better think about it, but I better jump on it because those opportunities don't last forever. And that's what I'm seeing with AbbVie. It's going through the roof. So I'm going to share with you on the screen now something really cool. Snapshot headline from their recent earnings report. And out of all the ones I'm sharing today, this is my favorite. They really share some good stuff just in the bold text at the top. But check this out. The third quarter net revenues were $8.479 billion. That's an increase of 3% on a GAAP basis or 3.5% operationally. And so it's interesting to see this company that so many people are worried about. International, Humira is already on biosimilars. Sales are down, yet the company is still managing to achieve growth. Mind you, this company is priced as if there will be no growth. This company at a PE of 9 even is priced as if it will shrink. So the fact that it is growing, I think that's a really good thing. They talk about Humira here. In the US, the revenues were up 9.6%. So just a blockbuster product that they have with that. And internationally, you could see a decrease of 33.5%. And so that's the risk with this. Biosimilars, it's off patent protection. Internationally, it's fading away. And so hopefully the new drugs in the pipeline like Skyrizi that have been approved and with this acquisition of Allergan, there's enough in the mix to compensate for that. But that's the risk with AbbVie. Again, though, especially where I bought it back in September at $66, it's priced as if it's shrinking anyways. And so if they can manage to not shrink, they can manage to eke out just a little bit of growth, man, these guys are set. So some more stuff. Let's see. Advances in their pipeline with regulatory approval of Rinvoq for moderate to severe rheumatoid arthritis. This is what's interesting. A lot of the drugs in their pipeline that are being approved, they're kind of related to Humira. I say whatever I want to say. I own the company. I call it whatever I want. But it's interesting that that's their strategy. And so, look, I don't pretend to be a medical doctor, a pharmacist to know this space that well. But I love if those in the community who know this space, I love this community. You guys are the greatest. 40,000 of us strong. I'm telling you, the value in this channel, it is the community. So make sure to spend some time in the comments. I always get these most thoughtful comments. If you're a pharmacist or doctor, I'd love to hear you speak to that. If you know more about their strategy and how they have all these drugs similar in the same space, if you will, as Humira, it's just interesting to see. And I think that they're thinking maybe these drugs could be the next generation of Humira, taking on Humira to the next step, if you will. So I'd love to hear what you guys think. Okay, so something else I like about this is a little weird to read. It says updates 2019 GAAP diluted EPS guidance range from 569 to 579 to 508 to 510. I think what they're saying here is they're updating the top end of the range from 569 to 579, and they're updating the bottom of the range from 508 to 510. And so they are growing their guidance. They're improving the guidance that they're giving the street. And you wonder, where does the street come up with their estimates on where things end up? This is where they get guidance from the company. But this represents growth of 39.1% at the midpoint. And this is inclusive, by the way, of a non-cash charge for Skyrizi contingent consideration. This is what I was talking about. Because you might be wondering, on the last screen, I showed you, hey, analysts are forecasting that this company is going to earn $8.90, but now they're guiding $5.69 to $5.79. The reason for that is the contingent consideration for the approval of Skyrizi. And so you go on to read adjusted diluted range. They're raising it from $8.82 to $8.92. Again, this is really weird to read. Adjusted diluted EPS guidance range from 882 to 892 to 890 to 892. I don't know what that's saying, but basically they're raising the adjusted diluted EPS. And if you look at that 892, it's similar to what analysts are expecting, which is 890. And so this is where the analysts honestly pull their guidance range. It's from the company themselves. But why is the adjusted diluted different than the GAAP? The GAAP includes a non-cash charge contingent consideration for Skyrizi. And so, again, something worth noting. And that's a good thing. They got approval for Skyrizi. And here you go. Announces 2020 dividend increase of 10.3%. Again, this is the kind of company I want to own. I want to own a company that speaks of the dividend up front and center. Because after all, what is the purpose of this company? Well, they have a charter mission to provide these solutions, these drugs that help people in the health space worldwide. But above and beyond that, I guess, or secondary to that, just slightly, it's the shareholders. They're in business to drive profit for shareholders. And quite frankly, if a company does not pay a dividend, I don't always feel that they're... Look, companies are in different stages, but I'm saying a mature company that can pay a dividend, they should, because that's the right thing to do for the shareholders that own the company. And I like that AbbVie and also StarBucks in their quarterly reports, front and center, they're saying, hey, shareholders, we know you're in charge. We love you guys. We care about you guys. We're working hard for you. And we want to highlight that front and center. And I just love that. I have mad love, mad respect for AbbVie, for StarBucks, all the baristas out there, all the employees of AbbVie. Look, the AbbVie, you've got some of the best scientists in the world working there on these next-gen drugs and solutions to improve society. Bless you all. Thank you for what you do. If you're watching this video, you work at Starbucks, you work at AbbVie, thank you. That's what I have to say as a shareholder. Thank you. I love you. All right, moving on. So picture me rolling. Love you, AbbVie. Man, it's just interesting how quickly things change. I want to talk now about Altria. This one is honestly going to be one of my favorite ones today. I'm going to spend a little bit more time on this one. And again, I'm jumping around today. I'm trying to be the best organized I can, but this is a little informal, I realize. So thank you for bearing with me. A bit of thug lifestyle here for sure. So Altria, I just did a video on Macy's. I'll link in the description below. And I'm calling Macy's for what it is. I believe it's a yield trap. People, as soon as I posted that, not a lot, but a few are like, Ian, but you own Altria. Isn't that a yield trap as well? No, it's not, in my humble opinion. And I want to share that today. I want to share why today. But I also want to just point this out because this is one of those stocks that, look, society loves to hate this right now. They're selling products. These products an adult consumer could use and enjoy if they want. But there's all these people in government, politics, this and that, saying what an adult consumer can and can't do, or They're imposing their values on them, this and that. Here's what I have to say to those people. Picture me rolling. I am getting a huge dividend on my Altria, and I'm going to share with you huge capital appreciation as well. So let me put some numbers on the screen. I love this thing. So price per share on Altria is $45.06. It's actually down quite a bit from their high. 3-year high was $77.28. So they're down 42%. So some people are thinking, Ian, is this a yield trap? No, it's not. We're going to get into that. The analyst estimate, 2019 EPS is a $4.20 EPS, gives you a PE right now forward of $10, 10.73 that is. They're trading at 10 times, just over 10 times earnings. In other words, by the way, if I buy Altria here and they keep earnings steady, they don't grow earnings over time. What this means is it'll basically take 10 years of earnings to make back my investment. That's how I like to look at PE. So 10 times. The dividend is $3.36, 7.46% starting yield. And the dividend was recently increased by 5%, but this was a while ago, a few months ago. Payout ratio is 80%. A lot of the skeptics will say 80% payout ratio. This is a yield trap. No, it's not. This is a company where not that much innovation has to happen. Also, this is a company where they don't want cash sitting around because cash becomes a target. The reason the payout ratio is high is they want to get the money to me, to the shareholders. They don't want it sitting in their bank account because all these politicians, they want to come after these guys. They don't like them. They want to impose their moral beliefs on them. And so anyways, the 5-year dividend compound annual growth rate, 10%. It's starting to dip a little, which makes sense. I think they're going to, in fact, I read in their recent earnings report, they're going to keep the payout ratio around 80%. And so if that's the case, dividend will only grow as quickly as earnings grow, which I think is going to be around 5% per year in perpetuity. And so the benefit here of Altria is you get a high starting yield, 7.46%, and that will be really high. But that 7.46% is probably going to grow at about 5% a year going forward, in my opinion. I bought this thing recently, actually. I bought some last week at $44.80. I bought it because I like the earnings report. We're going to talk about that in a minute. And I want to just share this because picture me rolling. I bought this thing back in 2009, $15.99. Even though this thing is down 42% from the high, I am up 182%. And my yield on cost, not even counting reinvested dividends, is a 21%. Meaning, for every $1,000 that I invested in that tranche that I bought at $15.99, I am yielding $210 per year. And so that is the power of dividend growth investing, compound interest, not even including the reinvested dividends there either. This is a simple yield on cost. And so I want to share a bunch of stuff here. I'm going to share some text on the screen. I'm going to share some information from their earnings report. There's a lot to go through with Altria, but I want to take a little bit of a tangent here. So I want to celebrate. What I'm trying to celebrate here with Altria, quite frankly, is what comes next. It's the good earnings. And so SBUX, I celebrate the good earnings, the dividend increase. At AbbVie, I celebrate the good earnings and the dividend increase and the fact that I bought the thing. I built up my position quickly. This one, their dividend increase was okay, but what I really want to celebrate is the high starting yield, the fact that it's still a value, that there's still opportunity to buy there, and the fact that they had a good earnings release. And so I want to get into that. So let me share first a few statements from the earnings release that I copied and pasted that I thought were really relevant for today's discussion. Okay, so it says our 2019 plans remain on track, and we reaffirm our guidance to deliver full year 2019 adjusted EPS growth of 5 to 7%. So again, is this Macy's? Not in my opinion. They're growing. The EPS is growing 5 to 7%. What else came out of this earnings report? In light of these considerations, we announce a compound annual adjusted diluted EPS growth objective of 5 to 8% for the years 2020 through 2022. Okay. This company believes that they'll be able to grow on a compound basis between 5 and 8% for the next few years. Again, is this Macy's? No, this company is growing. We'll get more to this. You'll see some cool numbers in a minute. Check this out. In August, Altria's board of directors, the board, increased Altria's regular quarterly dividend the 54th time in the past 50 years. Is this a company like Macy's? I don't think so. They're growing the dividend 54 times in 50 years. It's pretty special. What else? Altria recorded a third quarter non-cash pre-tax impairment charge of $4.5 billion related to its investment in Juul. And so we've talked about Juul a lot here. There's a lot going on with it. I wouldn't be surprised if they end up owning this whole thing over time. But what happened is Juul CEO is out. Altria put their own guy in. They paid $10-11 billion, and they're writing down a good chunk of that as an impairment charge, because they're basically saying that the investment that they made in Juul, it ain't worth what they paid. And so that's good to see. It's just good to see them being realistic with it. Hey, as an investor, I'm not going to sugarcoat it. Is it nice to see that they literally threw away $4.5 billion? Not necessarily. That's not good to see. That being said, you always have to read beyond the fine print. And so this is what I'm talking about. People on this channel, and I love you, because it took me over 20 years to get where I am. And so everyone has to start somewhere. But I had these same questions when I got started. I look at something like AbbVie. Why is their PE ratio so high? Again, it's not high. They had a contingent consideration for Skyrizi, throws off GAAP EPS, throws off PE. But people look at something like this. Oh, they lost $4.5 billion on Juul? Not necessarily. You got to think about this a few steps ahead. You got to think, okay, what's really happening with Juul? They bought a stake in the company. They didn't buy the whole company. They now got their own guy in the company. We know all these independent shops that sell these types of products, they're going to face a lot of troubles. FDA is going to just put them under. If this type of product continues to exist at all, it will probably be a regulated big company like Altria that can pull it off with a subsidiary like Juul. And so you start thinking, they got their own guy in there. They're working with the FDA. They got rid of all the flavors proactively. What's really going on here? They write it down. I don't care if they write it down. The cash flow that they're getting from their investment doesn't change if they write it down. I think what they're doing here, and I could be wrong, but I think they're setting things up to acquire all of Juul at some point in the future, because they're writing it down. They're saying, hey, it's not worth what we paid. It's worth $4.5 billion less. They got their own guy there in charge now. What's going to happen when they want to buy the rest of Juul? Are they going to pay what they paid before? Or are they going to pay this lower rate? Because after all, they had to write it down anyways. It's not worth what they paid. It's a mess. And so I wouldn't be surprised, again, with this write down. There's more than meets the eye. These are some of the savviest business people in the world, in my opinion, at Altria. And if you look at Altria over the long run and you count all the spinoffs, it's actually, in many studies, cited as the best performing stock of all time. So these guys know what they're doing. Just keep that in mind. What else? So Altria reaffirms its guidance for 2019 full year adjusted diluted in the range of $4.19 to $4.27, representing a growth rate of 5 to 7% from the adjusted diluted EPS of $3.99 in 2018. So 2018, 2019, they're growing, not Macy's. And so again, you look at that, you look at the analyst estimate. That's where I get these analyst estimates. That's where the analysts get the estimate, is from company guidance. So I want to take an opportunity here to share a bunch of stuff with Altria. So I'm going to start by putting some stuff on the screen. I want to start with just a snapshot of the earnings. And so here's their earnings. Let's look at this. It's a little convoluted, if you will, but this is a table of what's happening. Revenues are up. And so if you look at revenues Q3 19 versus Q3 18, they're up 0.3%. Revenues net of excise taxes are up 2.3%. And if you look at the year to date through Q3, they're slightly growing on revenues net of excise taxes, but net revenues, they're slightly down. Then they talk about tax rate. But here's the thing. The reported diluted EPS, it's negative in Q3 19. All these people are going to get thrown off. They're going to go to Yahoo Finance. PE is not going to look low anymore. It's going to look really high because they had this bad quarter. Keep in mind that they took a non-cash impairment charge against Juul, so that affects the GAAP earnings per share. It throws it off. That's why it's negative. But if you look at the adjusted diluted EPS of $1.19, it's up 10% year over year. And if you look at Q3 year to date 19, it's up 4.9%. And so Honestly, I don't want to get into the theory on this too much, but I wouldn't be surprised if the Juul stuff and all the drama that's happening with Juul, quite frankly, at this point, could be spilling over and helping their traditional business. And so that could be happening as well, because you just look at this. If you look at 2019 year to date through the whole year through Q3, they're up 4.9% on an adjusted diluted basis. But you look at the most recent quarter, just Q3 in isolation, you don't include quarters 1 and 2. They're up 10%. Okay, it's accelerating. Why is it accelerating here? I don't know, but there could be some stuff happening related to all this Juul drama that is a lot different than what the media is feeding us all. And so you got to read. You got to read below the headlines. You got to read the fine print. You got to not only read, but you got to think what's not on the paper. Like what I'm saying here. There's stuff not on the paper that you can infer from these numbers. And that's why it's hard to be a really good dividend investor. And quite frankly, that's why it's hard for a lot of people to realize, why is Altria different than Macy's? Look, I'm not trying to put anyone down. I love you all. That's a really good question, because I'll tell you, in my early days, I fell for a yield trap. I bought a mortgage REIT back in the subprime crisis. Thankfully, I didn't lose money on it, I don't believe, because I got in, I realized by mistake, I just got out pretty quickly. But we're all attracted to them. We all understand that high yields are enticing, and it's deciphering what's a yield trap, what's not. A lot of people could say AbbVie is a yield trap. A lot of people could say Altria is. I'm here to argue that they are not. And so on that note, I want to bring up another screenshot. I want to bring up their I'm going to start with this one. This is a selected financial data starting 2011. Mind you, if you want to see a yield trap, I'll link in the description below. Check out my Macy's video. You'll see a yield trap there. But check this out. Macy's numbers are just bad. But you look at Altria net revenues, they're up and to the right. 2011, it was 23 billion. 2012, 24.6 billion. 2013, 24.466. 2014, 24.5. 2015, 25 billion. Look, it's not a very fast growing company, but if you look at long periods of time, revenues are up and to the right. And if you look at let's just look at net earnings. Okay, net earnings go from 3.39 billion to 4.18 to 4.5 to 5 to 5.2. Again, this is through 2015. We'll get to 2016, 17, 18 in a minute. This is just from the annual report, the 2015 annual report. Another pro tip for all of you at home. If you want to be the best possible dividend investor, don't just look at the recent annual report. Look at prior annual reports. That's what I like to do. Go back in time. Does this look like Macy's to you all? Again, I'm not going to do a deep dive into Altria today. Maybe I'll do that in another video. I want to just share some high-level metrics, but when you just dig down a little, it's pretty apparent that this company is growing. Now, how is that? Because the media is so quick to point out the volumes of the product they sell are down. My understanding is those volumes have been down since the 1970s. The reason that the company is doing well is, one, they're diversified. They're in a bunch of different businesses. I think, by the way, their new product, IQOS, is going to be a home run. I know their counterpart internationally, it is a home run in Japan. We'll see if that happens in the US. But the media just loves to say, hey, volumes are down, companies going out of business. But what they forget to tell you, oh, these guys are diversified. Oh, these guys have pricing power. Let's talk about Macy's. There's no pricing power. They're selling, the minute those fashions hit their showroom, they're out of fashion. Deep discount them, get them out of there. They're carrying all this worthless inventory. This company, what they're selling doesn't change. There's no concern over inventory. There's no inventory risk. There's high margins here. There's no margins at Macy's, low margins. And so you're looking at two very different animals. Now, if you are here and you own Macy's, I don't mean to talk down about your investment. I wish you all the best. I hope Macy's does really well. But I'm just trying to compare why I think that's a yield trap. This is not. And I'm trying to also show you guys, do not always believe what you hear on the media, because the media is saying volumes are down. Media is talking about, hey, look, I live near San Francisco. And it honestly frustrates me, those politics there sometimes. just the fact that they would outright try to ban products, or with Juul, for example, they were saying, Juul, your headquarters are here, but we don't really need you here. We don't mind if you leave our city. Look, they brought jobs to the area. They should be supportive of it, but they're not. And so it is what it is. Look, I love SF. It's a beautiful place to live. But again, that's the backdrop. And so around here, you would think these companies are going out of business. You'd bring up a company like this with your coworkers at work. You could get fired over that because it is just the political climate of what it's like here. And if you're going to use one of their products on your break here, just be careful in this area because your employer, who knows how they look at that, this and that. But anyways, you look at that, people think it's a yield trap, but when you look at the numbers, it's not. And so I want to move on. I want to show you 2018 earnings. Okay, so I got 2018, 17, and 16 on the screen. And mind you, let's just start with the revenue. Where did we leave off, by the way, in 2015? We left off at 25.4 billion. Okay, well, 2016, we're up to 25.7, 2017, 25.5, 2018, 25.36. So since 2015, revenue hasn't been growing very quickly. However, it is holding. It's not going down. It's holding. And if you look at the net earnings, let's look. Here's where it gets really wacky. And this is where I think a lot of people get thrown off with a company like this. Net earnings are really high in 2016, 14 billion. Mind you, in 2014, the net earnings were 5 billion. Why are they so high? The reason they're so high is you see up here somewhere, where is it? There was something related to SAB Miller. There's a transaction between Miller and AB InBev that basically got them some kind of benefit, got them some kind of GAAP earnings benefit. And so I think, by the way, what happened, I don't remember precisely, but I think Miller, which they owned, was acquired by Anheuser-Busch InBev, and they got some money for that, but they still had a stake then in InBev. And so I think that's what it ended up happening. But anyways, GAAP EPS look better than they really are in 2016 because of the one-time payout. But again, you have to really look at the numbers to decipher this kind of thing. And look, I'll give a disclaimer. I'm not perfect at this. There's accountants who watch my channel, CPAs, and they hear me talking about this and they correct me sometimes. And I appreciate that. This is a community. This is a discussion. I'm not perfect, but you don't have to be perfect to get 90% of the way there. 2017, what's going on there? So net earnings were 10 billion. Again, mind you, 2015 was net earnings were 5 billion. So what happened there? It looks like they had some kind of benefit from income taxes, I guess. So that's the other thing. 2016, they had some big benefit from income taxes, and so that skews the numbers as well. 2018, back down to normal. We're at 6.9 billion, which again is way higher than 2015, which was 5 billion. Again, the picture I'm trying to paint here is over time, revenues are flat, if not up. Earnings are growing. And this is going to become even more apparent on my next screen where I show the cash flows. This is just the 2018, but check this out. Net cash provided by operating activities. 3.8 billion in 2016, 4.9 2017, 8.3 2018. Again, this is not Macy's. This is a company where the fundamental numbers are growing. The volumes being shipped on their traditional product, maybe they're not growing, but if you ignore the people, the naysayers, the people who want this to fail, and you just look at the raw data looks all right. And so what am I celebrating here? What am I doing my picture me rolling today with Altria? I'm really celebrating the fact that I feel super comfortable buying more here because the earnings report was solid. That's what I'm getting at. We got a solid earnings report. So thank you. I want to thank, if you work at Altria or you work in that industry, I want to thank you here on this video because I know a lot of people, they don't thank you. And so you deserve a thank you. Thank you for doing what you do, for rewarding us shareholders with what you do. So last one, Apple. Man, I love this. Let me just pop the numbers on the screen. I'm going to start out with this. I bought this thing late 2018, one of my tranches at $151. Now it's at $255. I'm up 70%, 69%. Why is that? Last year when I was buying, everyone's so scared about the trade wars, this and that. Look, Apple's done just fine, and we'll get to that in a minute. But needless to say, the stock is up. So what do I want to share? I want to share that the EPS, the analyst estimate, is a 12.93, so the PE is a 19.78. Not a great value, but I'd say for Apple, still an okay value at a PE under 20. Dividend is 1.2%. Dividend was increased. Last increase was only 5.5%. I'd like to see them increase it even more aggressively, but with a payout ratio of 24%, they got a long way to go. So they've got a lot of opportunity to reward us over the long run. By the way, I buy stocks like Starbucks and Apple for long-term yield on cost. I buy stocks like Altria and AbbVie for current yield. I like to mix them all so that I have yield when I need it now, because I'm already using some of my yield to pay bills, but I also get lots of yield in the future when I need it as well. And so compound annual growth rate on the dividend is at 10%. And they're at basically a 3-year high right now. They're doing just fabulously. And so I want to talk about Apple. It's one of the rare tech stocks that I own. Let's just look at this. I'm going to share on the screen the headlines from the earnings report. Okay. Services revenue reaches an all-time high of $12.5 billion. Nice. I like to see the diversification away from iPhone. EPS sets a new fourth quarter record of 3.03. So they're doing great. They announced quarterly revenue. It's just staggering, $64 billion revenue. The revenue is up 2% from a year ago. And quarterly earnings per share are up 4%. So EPS is up 4%, revenue is up 2%. Love this. International sales accounted for 60% of the quarter's revenue. Again, you don't have to buy a company that is based internationally to have international diversification. I have international diversification just by owning Apple. 60% of their sales come internationally. Thug life, I love that. So what does Tim Cook have to say? We concluded a groundbreaking fiscal 2019 with our highest Q4 revenue ever, fueled by accelerating growth for services, wearables, and iPad. And what else? With customers raving about the iPhones, noise canceling, got AirPods. Cool, I might get those. So on and so forth. I would have liked to see them mention the dividend here or stock repurchases. I guess that's the only thing that's missing here. But I want to take a victory lap here. I'm excited for Apple because a year ago, everyone was saying, hey, no one's going to be buying these iPhones anymore. No one's going to upgrade to the newest version. And so I'm just happy to see $12.5 billion services revenue. They're diversifying a bit away from iPhone, which is a big concentration of their revenue. But that being said, people are buying the new iPhone. I'll probably buy the new one sooner or later. And so good work, Apple. Nice to see it. I would say, what do I celebrate here, though, practically speaking? I would celebrate that I jumped on it when I could. I would celebrate that even though it's up 70%, it's still a reasonable value. It's not great, but it's not horrible. I'd celebrate just the fact that the company is doing well. It's doing well, and it's a company that a lot of people thought contained risk as it pertains to trade wars, as it pertains to concentration on a single product. And so I'm doing a lot of cheerleading, bragging, excitement today, and I'm doing it because it was a request. And quite frankly, I'm excited, and a lot of people think dividend investing is not exciting. I want to point out why it is, because I want to get people excited about disinvesting. It may not be for everyone, but I want to show people out there that dividend investing can be very fun, very exciting in a multitude of different ways. But one of the most important things that I need to remind myself and everyone out there, there's an awful lot of good news coming right now. In many ways, stocks going up, dividend increases, earnings are good. And it's happening all at once with a lot of companies. There's other companies in my portfolio I didn't even talk about that have good news now. There's some where they had like a lackluster quarter like McDonald's, but hey, McDonald's will get past it. But what I want to say is always stay humble as a dividend investor, because things can change like that. We don't want to get too full of ourselves. We don't want to get too caught up in our head. quite frankly, you get too full of yourself. You're not open to feedback. And one of the most important things that I think is the groundwork for this community is all the great comments and all the different perspectives that come in. And so please keep them coming. I love the debate. I like to be challenged. I like to think in different ways. I don't have all the answers, but I know in aggregate as a community, we have most of the answers here. We got answers. I have people coming here. I did a video about Johnson & Johnson, and I had people who were familiar with how quality control is done at these pharma companies and chimed in on that. I have accountants come and chime in on the numbers, the nitty-gritty of the financial stuff. This is a strong community. I love you all. Thank you for hanging in there in today's video. Before I leave today, in terms of a full disclosure, I am long the stocks mentioned today. I'm long McDonald's, ticker symbol MCD, Johnson & Johnson, ticker symbol JNJ, Starbucks, ticker symbol SBUX, AbbVie, ticker symbol ABBV, Altria, ticker symbol MO, and Apple, ticker symbol AAPL. I own all of those in my personal dividend stock portfolio. Also, before I leave today, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. All right, everyone. I am super tired. I'm losing my voice. Long video. I love you all. Please subscribe. It means the world to me. I'll see you in the next one. Picture me rolling. Thug life investing at its finest. See you in the next one.